Imagine this. You've bought the house. The paperwork is done. The keys are in your hand. And once the excitement fades, a new question quietly takes over your thoughts. Now what? Because sitting beneath the surface of homeownership is a number that's hard to ignore. The mortgage balance. 300,000, 400,000, maybe more. Every month you send a payment to the bank, and a frustrating portion of it disappears into interest. At the same time, you hear about people investing, compounding, letting their money work for them. And sooner or later, you end up asking the question that keeps so many people awake at night. Should I aggressively pay down my mortgage? Or should I invest that extra money instead? This isn't a trivial question. It's a decision that can shape decades of your financial life. So today, we're going to walk through it carefully, with real numbers, realistic assumptions, and a framework that respects both math and human behavior. By the end, you'll have a clear way to decide what makes sense for you. Let's start with a concrete scenario. You've taken out a 30-year mortgage for $500,000 at a 7% interest rate. That puts your monthly principal and interest payment at roughly $3,327. This doesn't include taxes or insurance, just the mortgage itself. Now fast forward 1 year. You've been making payments, settling into the routine, and then your income increases. Suddenly, you have an extra $1,000 per month that you didn't have before. This is the fork in the road. Do you apply that $1,000 directly to your mortgage as extra principal, or do you invest it in the stock market? Let's examine both paths. Scenario 1. Investing the extra money. In the first scenario, you decide to invest the extra $1,000 per month. Starting in month 13, you automatically invest it into a low-cost total market index fund. No trading, no guessing, just consistent investing. Historically, the stock market has returned around 10% annually over long periods. To be conservative, we'll assume a 9% return. We'll also assume that your income grows over time, so you increase your monthly investment by 3% each year. You continue this for the remaining 29 years of your mortgage. When you run the numbers, the result is striking. By the end of that period, your investments grow to approximately $1.83 million. That's real, liquid wealth. Retirement-level money. Financial independence territory. At first glance, this seems like the obvious choice. But before jumping to conclusions, we need to understand how mortgages actually work. How mortgages really work. Most people misunderstand amortization. Early in a mortgage, the majority of your payment goes to interest, not principal. Here's what that looks like in practice. On a $500,000 mortgage at 7%, your first monthly payment of $3,327 breaks down like this. About $2,917 goes to interest. Only about $410 reduces your loan balance. That means roughly 88% of your payment is interest. Even after 5 years, you're still sending well over $2,700 per month to interest. It's not until more than 20 years into the loan that your payment finally becomes mostly principal. For decades, the bank gets paid first. This structure is exactly why mortgage prepayments can be so powerful. Scenario 2. Aggressive mortgage prepayment. Now let's take that same $1,000 per month and apply it directly to your mortgage principal. Unlike your regular payment, which is mostly interest early on, a prepayment goes entirely toward reducing the loan balance. Every dollar counts. We'll increase this prepayment by 3% each year to stay consistent with the investing scenario. Here's what happens. Your 30-year mortgage is paid off in just over 16 years. You eliminate nearly 14 years of payments. The total interest paid over the life of the loan drops from about $698,000 to $318,000, saving roughly $380,000 in interest. That sounds incredible, but it's not the full story. To achieve that result, you made about $238,000 in additional payments over time. So the true net benefit is closer to $142,000. Meaningful, yes, but far less than the $1.83 million from investing. At this point, it may seem like investing clearly wins, but there's still one more piece missing. What happens after the mortgage is gone? When you pay off your mortgage early, you don't stop there. Once the loan is gone, you free up your entire monthly payment. That's $3,327 from the original mortgage, plus the $1,000 you were prepaying. A total of $4,327 per month. Starting at month 196, you invest that full amount for the remaining 13.75 years, earning the same 9% return. That investment grows to approximately $1.19 million. Add the $142,000 in net interest savings, and the total comes to about $1.33 million. So now the comparison looks like this. Invest from the start, approximately $1.83 million. Prepay first, then invest, approximately $1.33 million. Investing still comes out ahead, but the gap is much smaller. And now we arrive at the most important concept of all: sequence of returns risk. Stock market returns are not smooth. Some years are incredible, others are painful. And the order in which those returns happen matters far more than the average. If your early investing years coincide with a market downturn, your long-term results can look dramatically different, even if you do everything right. That's called sequence of returns risk. Mortgage prepayment doesn't have this risk. When you pay down a 7% mortgage, you are earning a guaranteed 7% return on that money. No volatility, no drawdowns, no uncertainty. In today's environment, a guaranteed 7% return is extremely competitive, especially because it's tax-free. You don't pay taxes on interest you never owed. This shifts the decision from what earns more on paper to what trade-offs am I comfortable with? The Freedom Fund Rule. Here's the reality. Personal finance isn't just math. It's behavior. It's stress. It's sleep. Some people are perfectly comfortable riding out market volatility. Others feel constant anxiety carrying large amounts of debt, even when the math says it's good debt. Neither response is wrong. That's where the Freedom Fund Rule comes in. Instead of choosing one extreme, you split your excess money between investing and mortgage prepayment. The exact split depends on you. Some approaches: 60% investing, 40% prepayment, 50-50 balanced. More investing when young, more prepayment as you get closer to retirement. A simple guideline: mortgage rate above 8%, prioritize prepayment. Below 4%, prioritize investing. Between 4% and 8%, do both. Let's test a 50-50 split. You invest $500 per month and prepay $500 per month, both increasing by 3% annually. The result? Mortgage paid off in about 21 years. Around $79,000 in net interest savings. Investments grow to about $842,000. After the mortgage is paid off, you invest the full freed-up payment, adding roughly $462,000 more. Total, about $1.38 million. Less than pure investing, but with nearly a decade of mortgage-free living. That trade-off matters. When one option clearly makes sense, there are situations where prepayment should take priority. High-interest debt, approaching retirement, job instability, significant stress from carrying debt. And situations where investing should dominate. Very low mortgage rates, no emergency fund, no retirement contributions, being young with decades ahead. But the deeper truth is this: the spreadsheet doesn't decide your life. You do. Two people can have the same house, the same mortgage, the same numbers, and experience it completely differently. The best strategy is the one you can stick to while still living well. The Freedom Fund isn't about maximizing dollars at all costs. It's about maximizing flexibility, stability, and peace of mind. Define what freedom actually means to you first. Then let the math support that vision. Because there isn't one correct answer. There's only the answer that fits your life. And as long as you choose it deliberately, you'll be just fine. If this helped you think more clearly about your money, consider subscribing. This channel is about calm, practical decisions. Not hype, not shortcuts. Just clear thinking that compounds over time. Stay consistent, stay intentional, and I'll see you in the next one.